What's going on, everybody? Welcome to the fourth quarter scouting report. My name is Adam Koós. I am the president, senior financial advisor, and portfolio manager at Libertas Wealth Management Group in Columbus, Ohio, Buckeye Country. I'm going to jump right into a little introduction here of how to get a hold of us. If you have questions about this presentation, if you want to get more information, because we only do these screencasts once a quarter, so you'd like some information faster, whether that be through our podcasts that we do. We do two different podcasts. One is for business owners exclusively. It's called Elevate Your Business. And then we do another one for everyone that we've been doing since 2015. That one's called the Retirement Fiduciary. So look up those podcasts on both Apple Podcasts as well as Spotify. And then you can also follow us on LinkedIn. You can find me there. There's a QR code you can scan just to go straight to my contact info and connect with me there. You can also find I go in waves on Twitter. I'll get active, then I won't be active, then I'll be active. It's kind of like if something's going on in the market, I'll typically post a lot, and then during the quarters, like this, quarterly scouting reports, halftime updates, market updates, I'll post some things like whenever something like this is happening because I have so many charts to share. You can also follow us on Facebook, and then we're on Instagram at libertas.wealth. You can find me there. So with that all being said, our agenda today is going to be the same as it typically is. We're going to go over the U.S. stock market. We're going to talk about international stocks. Then we'll switch over to bonds, fixed income investments, commodities. We'll talk a little bit about currencies, the U.S. dollar. Then we'll go over to digital assets like cryptocurrencies, talk about a couple there, Bitcoin, Ethereum. And then we'll go over some signals, indicators, kind of some big picture stuff that I kind of find as I'm doing my research on a week-to-week basis. And then we'll just wrap it up with what the big picture looks like right now and going forward. So I always start with a quote of the day, and this is a special day for me in terms of the quote of the day because Greg Morris officially decided to, after years and years and years of being a portfolio manager, an analyst, and an author of several amazing books on the topic of portfolio management and portfolio management and technical analysis. Sorry, I paused here because I realized the PM, the portfolio manager, ended up getting word wrapped down here on the left for some reason when we hit the presentation mode. But anyway, he's an author of several books. He's a technical analyst. He was a portfolio manager for years. Then he retired and he started writing for StockCharts.com, and I read every one of his articles. He was one of my early mentors. I remember, barking up his tree and trying to beg him to let me know what some of the combo indicators were in his book, Investing with the Trend, because the portfolio's actually being used, the model's being used at a portfolio management company in Texas. He couldn't give me all the details, but you get a magnifying glass out, you can kind of figure it out. But with that all being said, Greg's last post in StockCharts.com I just thought was worth sharing with all of you today. And he said this. He said, if you want success in the market, I honestly believe discipline must be a major portion of your approach. Finally, if beating the markets is your goal, I believe your investing career will be short. To me, that's a foolish goal. The goal is to try and participate in the up markets and try to avoid participating in the down markets. You do not need to remain invested at all times, as much of Wall Street wants you to think. So, Greg, thank you for all you've done for the investment community, for the technical analysis community, for the trend following community. Thank you for writing a few great books that are easy to read and understandable for just the average Joe, let alone technicians like me. And just thank you for your mentorship over the years and for everything you've done for me as well. So with that being said, let's go on to the meat of our conversation here. Let's start talking about the U.S. stock market first. What I'll show is this is just a chart of the S&P 500 going back to July of last year. You've got this kind of red line in the sand here, which would represent about a 20% drop in the market if the market were to head down that low. But as you'll see when we get to my inverse traffic light, which I always post in these videos as well as once a month in my my monthly market brief that we send out, the market would be in such, I don't want to say such bad shape, but it would be declining in such a way that by the time the market got even close to this red line, a lot of investments, whether it be U.S. stocks, international stocks, energy stocks, it doesn't really make a difference. A lot of these investments would probably start breaking down in trend, and in our trend following models anyway, we'd probably be raising quite a bit of cash. But the more important line in the sand right here isn't even a line, it's a shaded area, because there is kind of some choppiness here between the spring highs earlier this year. Then we can see the summer lows, kind of a short pullback here. Then we had the breakout to all-time highs in midsummer, and then that nasty July through August 3-week decline that had everybody freaking out, saying that the Fed screwed up and that they should have cut rates sooner. But then, of course, what we've had since then is kind of a shakeout. You can see where this low right here is a little bit lower than this low here in early summer. And then the market kind of headed right back up again, didn't quite print a new high, so we had a lower high. But then we had a higher low here that corresponded with the low that took place mid-correction this summer. And then we've seen all-time highs again. And now what we're seeing is some consolidation, some chopping sideways, which is completely normal, especially in an election year. And we'll get to that in a little bit too. Next is another chart of the S&P 500, but what I want to show you here is a couple things. First of all, obviously the price of the S&P is in the top pane here in the candlestick chart, and then you have the 200-day moving average. So the 200-day moving average, for those of you who are new to this, is just the trend of the S&P over the last 200 days. It just kind of smooths things out and shows you what the trend is over the long term. And then I drew a line here connecting the tops because I wanted to show you that in the lower pane, RSI, 14-period RSI, which is a momentum indicator, is printing lower highs. And not only is it printing a lower high, it's printed a lower high below 70, which is kind of a bullish line in the sand. We don't want to see that. This is kind of it's what's called a negative momentum divergence, but what it basically hints at is a potential decline in the future because momentum is waning. Now, the good news is back here in summer, even though the market had that nasty correction that was very quick, like I said, 3 weeks, the momentum bottomed above 30, and 30 is kind of the bearish line in the sand. So the good news is when that correction took place, we bottomed above 30, which was good for the market. The bad news is we've seen 2 peaks as the market's headed higher, and then as the market hit all-time highs, we're seeing a lower high in momentum relative to the previous highs. So that's the negative divergence, and that's kind of a hint of a potential. It's not a guarantee, but it's a hint of a potential decline in the future. And since we're 1 month out from the election, it wouldn't make anybody surprised, I don't think, if we saw a decline here this month, especially since September and October are not necessarily good months for the market in an election year. And again, we'll get to that in a little bit. The next thing I want to go over was the Russell 2000. I've talked a lot about the Russell this past, I'll call it 9 months or so, 10 months, because we've been kind of waiting for the Russell to catch up. And when you look at this chart on its own, you might say, well, it did catch up, but it didn't, because when I say catch up, I mean on a relative basis. So if I go back again to the S&P 500, you can see that just since July, we can even look at November, but since July, the market has done, pretty well. When you look at small cap stocks, though, which is what the Russell 2000 represents, is small companies. Yes, it's done well, but I mean, the S&P 500, the Dow, NASDAQ, they've already seen all-time highs several times. Whereas when you look at small companies, partially due to interest rates being high, we haven't even gotten to all-time highs yet, let alone broken out to all-time highs. So this is going to be something that's going to get really interesting as interest rates continue to get cut, and as they produce more stimulus in China, lowering rates there, flooding the economy with some money, some stimulus. So this is something I'm paying very close attention to, because I think at some point we're going to start to see small caps catch up and start to outperform on a relative basis. And of course, we want to be a part of that. Then we have the relative comparison chart. So this is why we aren't in small caps right now. We were pretty heavily invested in small caps earlier this year. When you can see we had a breakout in early 2024, kind of late 23, and then we had this decline on a relative basis, went back underwater. This shaded area is the 150-day moving average, so it's the 150-day trend of the relative comparison or relative strength between the Russell, so small cap stocks, versus the S&P 500, so large cap stocks. So in other words, when this chart is trending down, that means that small cap stocks are underperforming the S&P 500. If it were trending up, that would mean small caps are better. They're outperforming. So what we just saw here this summer was this very, very brief but quick jump in outperformance, but it was short-lived and we're right back underwater again. So what we want to see is kind of for this chart to kind of base out and head sideways, and then to start to see the 150-day moving average start to churn upward, all while the chart ends up above water. So we want to see the line above the blue area, the blue shaded area, and at that point we're looking at a time when potentially we want to get into small caps in a big way. When we look, speaking of small caps, this is the small cap seasonality, looking at July through December 31st since 1979. And I just thought it was an interesting chart. I can't remember where I found this one, but basically, October 2nd was a few days ago here. What is it today? The 4th, I think. I don't know. It doesn't matter. All the days blend together these days. So we've got October 2nd, which was right here. And then the average performance of small caps, you can see, tends to bottom, seasonally speaking, right around the end of October, and then Election Day being November 5th, you can see is on the way back up the hill. So seasonally speaking, the trend historically is for small caps to decline into late October and then to head higher through the end of the year, which also correlates with a lot of what you see with large caps as well. The question is, are we going to see outperformance on a relative basis of small caps relative to large caps? Here's another comparison, a relative strength comparison. This one, we're looking at discretionaries versus staples. So discretionaries, just think of them like luxury goods, things we want, things that are fun, whereas staples are the things we need. They're the things that we have to have no matter what. Soap, I suppose we don't need soap. We probably should buy soap, but razors, food, things like that. Whereas discretionaries would be luxury goods that we don't necessarily need, but we want. So when we see this chart trending up, that means discretionaries, or in other words, the things we want, are outperforming the things we need. That means we're in a healthy market. When this starts trending down, and when you start to see this chart underwater, that means that the things we need are outperforming the things we want, which is not good for the market, because it's hinting at that maybe people are focusing less on the things they want. They're hoarding their money. They're focusing only on the things they need because they're worried about a future market drop. So right now, what we have, in my opinion, is a slightly we saw a declining 150-day moving average here, but it's kind of flattened out. And then you see it's above water, so that would insinuate that the discretionaries are winning, or it's a risk-on environment. But it's also, if you look back, going to a year ago, we'll just say it's flat. It's kind of trendless. So I think we're at a place where the market's at a point of indecision. It doesn't really know what's going on right now because we got this huge election coming up here in a month. And I think that once we know what happens with the election and how the market reacts to it, so let me rephrase that statement, it has a whole lot less to do with who wins the election and a whole lot more to do with how the market reacts to the election. I think we'll know a whole lot more about what's going on at that point. But for now, we see this point of indecision, which is good. And the reason that's good is because if the market didn't like this election, regardless of who gets voted in, then you would see discretionaries underperforming. We would see a downtrend here in this 150-day moving average, and we would see that discretionaries are underwater relative to staples. And what we're seeing right now, again, is a trendless, choppy, sideways environment, which is just digestion. It's healthy. There's nothing wrong with that. So that's a good thing. Now we have technology versus utilities. Now this one is interesting. So we saw the sideways choppiness of discretionaries versus staples, but in this one we're seeing something that isn't so rosy. So technology is in the is basically doing well if the chart's going up and we're above water, and if utilities are outperforming, then the chart is going down and we're underwater. So in this chart, you can see we've got a high here in early 2024, a slightly lower high, and then we have a lower low, a lower high, and now we're underwater. Now, this last few months, it's kind of been chopping sideways, but needless to say, chopping sideways underneath water, or as I call it, a 150-day moving average, declining 150-day moving average. So I think we're going to want to see this improve. This chart's going to need to improve if the market is going to continue doing really well. It's not an on-off switch, by the way. All these charts that you're looking at are a weight of the evidence approach. You never ever, in my opinion, you never ever want to use one chart or one comparison like this, a relative strength comparison, and say, well, if this happens, then I'm going to go leveraged into the market at 150%. And if this other thing happens, then I'm going to sell everything and go to cash. It shouldn't be like that. It should be a dimmer switch, not an on-off switch. So this is just one of the pieces of evidence that we're looking at. And right now, anyway, utilities are outperforming technology, which is not good. That's a bad sign, or in other words, it's a check mark on the other side of the T chart for the market. And but if I go back and I look at the S&P chart one more time, at the end of the day, we've got higher highs and higher lows. That's an uptrend. It's an unequivocal uptrend. And so it doesn't matter what indicators we look at, what relative strength comparisons we look at. At the end of the day, the most important thing is price, and whether price is going up or trending up, or if it's trending down. If it's trending up, we want to be involved. We want to be buying dips. And if it's not up, then we want to be selling rallies. In other words, selling on strength, and maybe scaling back, dimming down that switch. But right now, that's not what we're seeing. We're seeing a long-term uptrend, an intermediate-term uptrend, and anybody who tries to tell you otherwise is trying to scare you or trying to sell you something. All right. This is a relative rotation graph of all the sectors in the U.S. market. So when we're in the upper left-hand quarter, that means it's improving versus the S&P. Upper right is beating the S&P or leading the S&P. Lower right quadrant is weakening versus the S&P, and lower left is lagging, underperforming. And what we're seeing right now is the energy sector underperforming. We see the communications sector kind of starting to hook or curl northward and point northeast, which is good, potentially, I should say good. It obviously has to get out of this quadrant and head northward into the improving quadrant. But the things that are doing really well, again, back to utilities. Not only is this in the leading quadrant, but you can see it was in the weakening quadrant and then jackknifed northward and is now heading northeast in the leading quadrant, which is about as strong as it gets. Real estate is also in the leading quadrant, although it is starting to point down and move toward the weakening quadrant. And then other than that, discretionaries here, which here, it's kind of ironic, but we were looking at discretionaries versus staples. Well, here's discretionaries right here, and you can see it's pointing northeast in the improving quadrant. So in other words, pointing toward the leading quadrant in the improving quadrant, while staples right here is in the leading quadrant pointing southward in the weakening direction. So that could be a telltale sign that we're going to see a change in trend here, and that when the election is over, that we're going to start to see, the things we want outperform the things we need. We could see utilities start to struggle versus technology, and start to see technology maybe jackknife and head northward back into the leading quadrant as well. But we will see. We don't know. We don't predict. We are not trend predictors here. We are trend followers. This is just a quick look at a bunch of stocks on the S&P 500 that are pointing northeast. This is just a code or a program that I wrote. I'm lying. I didn't write it. My friend Darren Hawkins at Optima wrote this program for me. Let's be honest. I'm not a software developer. But anyway, we wrote a program on an RRG, relative rotation graph, where basically what I'm looking at here is 2 standard deviations away from the center. So the center is the S&P 500. The reason why I took 2 standard deviations outside is because I don't want something that's performing right with the market. I'm looking for things that are a little bit more, outperforming more than 2 standard deviations from the center. So you can see Dexcom down here is in the lagging quadrant, starting to point northeast, but it's still pretty deep down in the lagging quadrant. Some things that look pretty good, though, on the other hand, are stocks like Disney. You can see here, there's 3 in a row. You can see the symbols that are pointing northeast. Lululemon pointing northeast in the improving quadrant. So those are the candidates that are always on our radar when we're looking at trend changes and looking for potential candidates to buy in our portfolios. One that's always interesting, I've been following Palantir because a client of ours owns a pretty large sum of it for a while here, and you can see Palantir just kicking butt and taking names here, way northeast in the leading quadrant, well outside of 2 standard deviations, so that's obviously a good thing for that stock. So let's change gears, talk about international stocks. I'm not going to talk a lot about them because honestly, they're not the strongest in the world. U.S. stocks continue to, with very, very rare changes, continue to be the strongest asset class in the world. Right here, you can see the all-country world index, not including the U.S. So this is all the stocks in the world except the U.S., and it's still about 4.4% away from its all-time high. So kind of like small caps, hasn't quite caught up. Hasn't printed a new all-time high going all the way back to mid-2021. And then the comparison I was just talking about, comparing international to U.S., which one's better, which is the better investment to own. You can see here in 2023, between late 2024 and mid-23, international was the place to be. And we actually went initially about 10 to 20% in international. Then we pushed it northward a little bit, pushed a little heavier in international, and then it failed. And when that trend failed, we had kind of scaled out, cut half our position, then completely got out of international stocks at that point. And since then, it's pretty much just been a downtrend. So, I'm watching this all the time. I'm looking for a trend change, and I can't expand this chart and show you. But if I went back literally to 2007, 8, and 9, the Great Recession, what you would see is a bunch of little moments of outperformance that are smaller than this one, smaller than the one we saw in late 24, early 23. But just generally speaking, the United States has been the stock market to be in. And the reason that's so important is twofold. One, if the U.S. market's the best place to be, then we need to be focused on buying stocks and buying investment sectors, ETFs in the U.S. stock market. That's the first reason. The other reason that's less important but good to know, and in my opinion, crucial for everyone to know, is it goes right back to that Greg Morris quote that we started with, talking about outperforming the market and things of that nature. If you want to outperform the market and you live in the United States, good luck, because you're going to have a tough time consistently beating the market if your market, the market you live in, being the S&P 500 is the United States stock market, if it's the best performing market in the world. That's something called home country bias. People don't talk about it a lot, but it's super important, because if you live in Singapore, or if you live in Japan, or if you live in Australia, then for you, it's been pretty easy to beat your market, or beat the market. I live in Australia. I don't literally live in Australia, but if I lived in Australia, I'm trying to beat the ASX, the Australian stock market. Well, all I have to do is buy U.S. stocks for 14, 15 years. Now, it's not that simple. Obviously, there's a little bit more that goes into it than just arbitrarily buying U.S. stocks. But my point is, if you're trying to beat the market, especially when your market is outperforming, then it's really a fool's errand. It's not until we start to see other countries outperform the U.S. that we start to see outperformance, as well as market declines. When the market goes down, as Greg was saying, you don't have to stay in the market. You can rotate from weakness to stronger positions on a relative basis, helping you outperform. You can get out of the market altogether, which is what our trend following models do. So there's other ways to do things than just staying in the market all the time. And then when it comes to beating the market, again, you always have to keep in mind that what market are you trying to beat? If you live in the U.S., it's been a really, really tough thing to do for 15 years, again, unless the market's going down. So with that being said, let's see. We got one more here. This is just EEM. So this is emerging markets, so small cap international stocks, small companies overseas versus the S&P. And the reason I posted this one this quarter is because I found it interesting that we're starting to see another jump above water here. So the question is this going to be a sustainable jump where it comes up and pulls back to the 100-day, 150-day moving average, and we start to see an increase in trend? In other words, we start to see small cap international outperform the U.S.? Or is it just going to be another one of these things like back here in 2022, when it jumped above water and then fell right back below and continued the downtrend, or here in early 23 when it jumped above water, right back down into downtrend? Is it going to be one of those situations? And we don't know until we get there, which is why it's called trend following, not trend prediction. You can get yourself into a lot of trouble trying to guess, hope, pray, and predict what's going to happen, only to get chopped up and find yourself buying these highs and then selling after it heads back down again. All right, let's talk about bonds, fixed income. I cut out some of the charts this time because I think there's less to talk about in the bond market. Things have been so bad for so long with rates. When I say so bad for so long, I mean so bad for 2-3 years. But they're starting to improve. And what I mean by that is you can see this peak on the right here in interest rates. This is the 10-year Treasury, which is what a lot of people use when they talk about the mortgage rates. So you can see since earlier this year, we're starting to see a decline, then a rebound, and now a lower low on the 10-year note. So now we're going back to 2002, 2003 before we can see those rates, whereas earlier this year we were looking at 1998. That's the kind of rates we were looking at, as rates from the 90s. So as the Fed continues to lower rates, we should start to see lower rates here as well. That's going to correspond with lower mortgage rates, perhaps give you the opportunity to refinance homes that you've purchased or refinanced in the last couple of years, and help decrease your total cost of living. So kind of fingers crossed for that. This is the 30-year note, 30-year Treasury. I'm only looking at this since 2020, so pretty much since COVID. And you can see here that it peaked out in October of last year, and we're starting to see a decline. But we still have these lows to contend with here from earlier this year. So as the Fed continues to lower rates, we want to see this drop below this prior low here in 2024, and to see lower lows, lower highs. And that's going to help, I think, not only mortgage rates, but it's going to help bonds. Bonds go up when rates go down. When rates go up, bonds go down. So as rates were going up since COVID, bonds were being decimated. Some down, 20, 30, 40, even 50%. Some people lost half their money in the bond market over the last few years, and because of this relationship. And it's not, and I want to remind you all, if you haven't seen this video in the past or haven't read our content in the past, it's not a matter of speculation. This is just how it works. When rates go up, bond values go down. It's not if rates go up, I wonder if bond values will go down. No, they go down. If rates go up, bond values go down, and vice versa. So when rates start to come down, bonds start to perform better again. They start to go up in value. So we want to be on the right side of that curve. And obviously, as rates start to head down here, we want to be participating in the bond market, and we want to be participating in the strongest positions in the bond market, which is what I like to call the playoff teams. So we want to stay invested in the playoff teams within the bond league, and we want to avoid all the rest. Here is bonds. Speaking of bonds, this is 30-year treasuries. You can see COVID right here, and then just an absolute drop in value here. You can see the drop was about 33.5% still as of today, going back to COVID. But we're starting to see, here's a low back in October of last year. Here's a high in early 24, a higher low in spring, and then a new higher high just recently. And so that's what we want to be buying into now. We've got an uptrend in place. We've got a pullback. We want to be buying these dips, and we want to be heading, as long as the trend remains up, and right now it's up. So we want to be buying stocks and bonds and commodities that go up, not ones that go down. All right, and then we have the 20-year treasury, and I just wanted to show basically a more zoomed-in version here of what I just showed you a second ago with the 30-year. So this is, you can see here, short-term higher lows, higher lows, higher lows, and then again, here's a high here, and then a higher high. Now we've got a pullback, but we've got this major higher low here. So at this point, it's just a matter of watching this thing. And, if this breaks down and we start seeing lower highs and lower lows again, which is, I think, unlikely because of what the Fed's doing. But if that did happen for some reason, then, we need to be careful with our bonds, just like we should have been careful. If you weren't careful, I should say you should have been careful 2-3 years ago. Full disclosure, we spent, over the course of 2 years, we might have been in bonds for 2 or 3 weeks. And that was it over the course of that entire time period. Instead, we focused on 1 to 3 year treasuries, so short-term, ultra-short-term treasuries, money markets, paying 5.4%, essentially just trying to stay away from the decline. So moving on, this is the S&P 500 versus bonds. So it's another relative chart, 150-day moving average here, and you can see stocks here in the U.S. outperforming bonds pretty consistently. There was a couple little times here. This was the correction that took place in July, August. And then here was another drop here where it went below water just briefly. But we're back above water. The trend is up. U.S. stocks outperforming bonds still. So that doesn't mean don't buy bonds. That just means that, if you're in a balanced portfolio, like a 60-40 portfolio, what I would have been doing is I would have been staying away from the bond market for the last couple of years. But now I'd be getting back into the bond market with that 40% sleeve that's allocated to bonds instead of having it in money markets. But U.S. stocks are still outperforming. So if you were in an aggressive portfolio, for instance, and you have 100% of your money in stocks, then you wouldn't want to be buying any bonds, obviously. So that's what this means. All right, here, another relative strength chart. This is the bond market now instead of the stock market. The middle is the AGG, so it's basically the Barclays Aggregate Bond Index. So think of it as the bond market. And then we have short bonds here in the lagging quadrant, way, way, way far bottom left. And then we have zero coupons, so 25-year treasuries, 20-year treasuries, corporate bonds, 7 to 10-year treasuries. These are all kind of in the leading quadrant here. And then we see here world inflation-protected securities moving northward out of the lagging quadrant, pointing northeast. So that's good too. So bottom line is, when we look at the stock or at the bond market and we drill down and we want to see what's doing best, you can see here TLT, zeros, VCLT, corporate bonds, things like that. Real quick, I'm bringing this up because in my 23-year career, we had up until a year and a half ago, 2 years ago, we had only put clients into fixed or indexed annuities, it was typically fixed annuities, 3 times ever in 23 years, right up until 2 years ago, so 21 years it would have been. Interest rates, because they got so sweet, even though we didn't like them in our mortgages, of course, but because the interest rates got so high relative to what we were used to, these fixed indexed annuities started looking good for the first time in 2 decades. So what we were doing for a while there was we were allocating some of our clients' money who were more conservative into an investment like this that basically gives us a guaranteed fixed account of 5.45%. I'll ignore the dual trigger just to keep things simple here, but a performance trigger, basically that if the market's up at all, you get 9.25 so at the end of the year. So if it's up 1, you get 9.25. If it's up 5, you get 9.25. If it's up 15, you get 9.25. So if it's up at all, that's the trigger, and then the 9.25 is the credit you would get. And then the S&P cap, 9.75 in the S&P, that would just simply mean that a year from now, if the market's up 1, you get 1. If it's up 5, you get 5. If it's up 10, you get 9.75. If it's 15, you get 9.75. So these rates started to look really good. Now, this is June 17th, and I just wanted to point out we're not getting those rates anymore. So because the Fed is starting to lower rates, we saw this big rate cut this past month, we're starting to see lower numbers. So now the fixed account available as of September 18th here, and this will change soon. These do update over time, and as rates come down, these will come down. Now we're seeing fixed rates at 4.6%. Performance trigger is now 8%. And the cap is now 9, so it's going down. And if rates get down so low again, where these don't make sense to buy or to own in conservative portfolios, then they just don't make sense to own anymore. And I'll stop. You won't even hear from me about them anymore. I'll stop talking about them. But for now, they're still pretty attractive as a portion of the fixed income or bond allocation of your portfolio. Commodities, currencies, changing gears here. Let's talk about the commodity market. Not too pretty. The big thing I want to point out, 2 things I want to point out about this chart, is a reminder that in 2022, commodities were pretty much the only thing going up. Not literally the only thing, but I mean, by far the best performing asset class. You can see here, end of 2021, market starts collapsing. Stocks are going down here in the U.S. Stocks are going down internationally. Bonds are going down because interest rates are going up, as we just learned. But commodities were just kicking butt, taking names all day long, right up until around mid to end of year 2022, when the market starts to recover in October, and now we see this downtrend. We saw a little bump here. I don't know if you can see this, but kind of a head and shoulders pattern. Left shoulder, head, right shoulder, not perfectly symmetrical, but neckline's right there. It breaks down, goes underwater, and we're back below a 200-day moving average. So right now what we're looking at is a little spike recently. I think a lot of that has to do with what's going on in the Middle East. Missiles being fired at Iran. Iran firing missiles at Israel, and everybody wondering how Israel's going to react to that, how they're going to respond. So we're starting to see a spike in oil prices, primarily energy prices, but we'll see if that holds. I don't know if it will, but right now this is definitely not something that I would be focusing on. The U.S. dollar. So switching to currencies here. U.S. dollar has been interesting. I mean, you've got I don't mean to start up controversy here, but inflation by definition is the increase in the value of goods and services due to the deflation, or I shouldn't say deflation, but the devaluation of a nation's currency. So when you look at Venezuela's prices going up, that's because their currency's been falling. Their currency in their country, and when the currency goes down in value, it takes more of that currency to buy stuff, which is why they go up in value. In the U.S., we haven't seen that. We haven't seen inflation by definition. What we've seen is an imbalance in supply and demand, and thus the price of things just going up as a result of that. Now, if the U.S. dollar were to collapse or start to really head down into a severe downtrend, which it hasn't yet, it's kind of, we've got a long-term, call it 2-year sideways choppiness, almost like I would almost call this a triangle pattern. If I drew a line here from the tops and then drew a line through the bottoms, I would skip this little island here. But we've got just a triangle, which, I don't know. I don't want to get into the technical details too much and tell you what I would expect to happen here, but I don't expect the U.S. dollar to collapse anytime soon. That's not what I see happening right now anyway. And again, trend followers, not trend predictors. So I think the U.S. dollar looks fine. I don't see any reason why we need to worry about, buying ammunition and food yet. I shouldn't say yet. I'm anything but a fear mongerer, but right now it's just interesting because the dollar stayed pretty strong. So that's a good thing for our country. This is oil. Oil again did really well in 2022, but since the market started to do better here in the stock market in the U.S., energy did not do so well. Again, you've got this little pop here in late 2023, but right now we're underwater in a flat 200-day moving average. Then we have gold. Gold's been kind of the talk of the town for a while. You got this really, really, really long base here going all the way back to 2020. In fact, if I could take this back even further, if I expanded the chart, it goes back even further than that. But you've got a high here, can't stay above it. High here, can't stay above it. Hits a ceiling again, and then all of a sudden it breaks out and consolidates a little bit, breaks out again. And you'll notice these things, what they're called measured moves, where you get this breakout here, and if you measure the distance, which I did not do, by the way, you measure the distance from here to here, and then you take the bottom and you measure that distance from there to here, the distance tends to be relatively similar. Not equal, but similar. And so what I did was I took, that was a very small pattern, so you can see here a big upswing, consolidation, then another upswing. What we're seeing in the bigger picture, though, is that whole move was a move, then a bigger consolidation took place, and now we've seen another measured move, and we're starting to see gold stall here. So technically speaking, it would not surprise me to see gold maybe start to hit a point at which it's either going to flatten out and start chopping sideways again, or it's going to pull back, or it's going to head higher. But it's going to take some serious momentum to keep it going, especially as the world changes, election takes place, interest rates are coming down, things of that nature. So inflation too. Inflation is coming down. So, all right, silver. Different story. Silver does not look like gold. You've got this little cup here, saucer if you want to call it, no handle yet. Don't even know if there's going to be one, but you've got the highs back here, and it has broken out, but it's messy. Silver just is clearly outperforming gold. I don't need to show you a relative comparison chart, but yeah, that's silver. Gasoline, kind of similar to silver, even though they have nothing to do with one another. But you can see here gasoline, since COVID kind of ramped up from April of COVID all the way up until April of 2022. And since then, it's just kind of chopped sideways. So prices have pretty much stayed relatively flat over the last 2 years. And then we have the S&P here versus commodities. So this is U.S. stocks versus commodities. It's again a relative comparison chart, or RS chart, relative strength chart. When it's going down, commodities are outperforming. When it's going up, U.S. stocks are outperforming. So what we saw here again, this is just another reiteration of 2021-22. Commodities were the place to be. 2023 hits. U.S. stocks have been the place to be, with very, very rare circumstances where it didn't make sense, which was, again, you can see here late 23, where it made more sense to be in commodities. Right now, U.S. stocks all day. Get into cryptocurrencies. Bitcoin has pretty much been chopping sideways here for the entire year almost. You've got these highs to contend with from early 21, late 21, the halving that took place earlier this year, and every other halving that had taken place in Bitcoin led to really new big breakout prices. This time it is different. We've basically just kind of seen this consolidation and steady but not volatile, not too volatile declines sideways. I mean, some people might consider this a lot of volatility, and I've really zoomed out here. But we're sitting right now below a declining 200-day moving average. I think this is still hands off. This isn't really, I'm not seeing anything that's constructive right now that leads me to believe that, I'd want to be heavily invested in Bitcoin. And Ethereum looks the same, not the same, but similar in terms of strength. We've got high over here, all-time high in late 2021, then this kind of decline and this, smiley face pattern here. We get back above a rising 200-day moving average, then we get a lower high, lower low, lower high, lower low, and now we're below water, we're underwater, we're drowning in Ethereum, right? And a declining 200-day moving average, which, again, not someplace I'd want to be. And then when you compare the S&P to Bitcoin, so this is another relative comparison chart, relative strength chart. If it's going up, then the U.S. is outperforming Bitcoin. If it's going down, Bitcoin is outperforming the U.S. stocks. And right now what we're seeing is, a rising 150-day moving average, and the U.S. is outperforming. So, again, the U.S. wins. All right. Kind of a bunch of signals, breadth indicators, things like that. First one here is the S&P 500 in the top, and the bottom is the percent of stocks in the S&P 500 that are trading above their 200-day trend line, trading above their 200-day moving average. So whenever I showed you those blue areas on a stock chart or an index chart, this is 74% of the stocks within the S&P 500 are trading above that line, which is good. That's obviously healthy. This next chart is the percentage of stocks trading above their 50-day moving average, so more of a intermediate term trend, if you will, even short to intermediate. So 72% of stocks are trading above a short term or shorter term 50-day trend line, 50-day moving average. The next one here is this percentage of stocks within 20% of a 52-week high or 12-month high. 85% of stocks in the market are trading within 20% of their 1-year high. That's also good. It's also healthy. It's also good to see it trending up, by the way. Here is Sentiment Trader's risk on-off indicator. It's a conglomeration of a bunch of different indicators. You can see here there was a moment in time where it didn't look so good here in earlier this year, but since then it's pretty much, for the most part, been in the black. So for the most part, it's been positive. The next thing I wanted to show you is Lowry Research, one of the many pieces of research that I subscribe to. And what I wanted to show you first was, this goes back to 2016, before the 2016 election. And what we saw here, the Dow is in the top, and then on the bottom pane here is buying power versus selling pressure. So what we want to see in a perfect world, in a good market, a healthy market, is selling pressure declining, buying power increasing, and in an even more perfect world, buying power is above selling pressure. But in 2016, what we saw was kind of a declining and then in a sideways kind of choppiness movement in selling pressure, with selling pressure above declining buying power. That obviously was not the best thing in the world. However, after the election, things went just fine, and we saw the market start to take off, and this all changed. Now this is the next election. This is the 2020 election. Instead, this time we had buying power above selling pressure, which was good. But the problem is we had declining buying power and then rising selling pressure. So then into 2020, obviously, the market still continued to do well. This was fine at the end of the day, and we didn't have anything to worry about. So when we start worried about elections and things of that nature, you have to keep things in perspective. This time is even better right now. This is this year. This is right now. We see buying power above selling pressure, but not only do we see buying power above selling pressure, we see rising buying power, higher highs, higher lows in buying power, and declining selling pressure. That's good. I don't care what you see on the news. I don't care what you see on TikTok. I don't care what algorithms have bitten you and they're following you around and trying to scare the crap out of you about this election and politics. Politics has no place in your investment decisions. Does the election matter? A little bit. But at the end of the day, what really matters is, are people buying stocks? And are more people buying than selling? And if that's happening, price must rise. And if more people are selling than buying, price must fall. So the question is, how is that relationship going to change when the election takes place? And by the way, one of the things we're going to talk about in a second here is seasonality. And typically, September is the worst month for the stock market in any year. And then September and October are typically the worst months for the stock market in an election year. We just saw a positive September. Let me repeat that. September is the worst month for the stock market, period, and in election years, and it was positive. So whenever we see the market buck trends like that, that is really good for the market. And now October, we'll see what happens, in the next 30 days. But so far, we're not seeing some precipitous decline. And again, what we're seeing is an increase in buying power and decrease in selling pressure. So that is a good thing. Now, this isn't a bad thing, but it's not a good thing either. We're not neutral, but we're slightly above neutral here in the greed. So this is the CNN Fear and Greed Index, which was just updated. I got this yesterday, so I'm recording this on October 4th. But we're in the greed area. Obviously, when it gets really, really high, when we start to see sentiment get really, really extreme on the top side, that's usually an indication that there's a good chance the market's going to decline in the short term. When it gets really low here into the fear and extreme fear side of the meter, that's a good indication that we'll probably see a bounce or a resumption of the uptrend if the market's in an uptrend. But you can see here that a month ago it was neutral, and just a year ago it was we were at extreme fear, and people freaking out, and of course the market's gone higher. So don't listen to the news, and don't let the news decide what you guys do with your portfolios. So if this doesn't tell you, I don't know what else will. All right. Back to Sentiment Trader here. The current spread, this is what's called the Smart Money and Dumb Money Index. It's not meant to be disparaging. It's not meant to be rude, but it's just basically we're looking at speculators versus commercial traders. So we're looking at basically the smart money, what they're doing, the professional money versus the retail trader. And you can see dumb money confidence is getting really, really high. versus smart money, which is getting low. And when you look at the spread, what sentiment traders are saying based on their historical results is that the current spread suggests that an average return over the next 2 months would be a negative 1.1%. So that would be, again, a checkbox in the negative column, and when we're looking at weight of the evidence. But again, price is the thing that matters the most. Trend matters most. If price is going up, we want to own stocks. If it's going down, we don't. This is going back to the election years I was just talking about. So you can see here, September, and the average year is down 0.8% since 1950, down 0.4 in an election year. And October is normally positive. Normally 1.5% is the rate of return for average October, but in election years it's down 0.8%. So 2 bad months is what we should expect. So far we got a positive month in September, not a negative month, and then October remains to be seen. Political alignment, this is just a fun stat. I like to post this a few times each year in articles, videos that we do, because this is the average rate of return of the stock market, the Dow that is, depending on who is in office, who's in Congress, who's in the Senate, and so on. And I'm just going to talk about the best and the worst. So the best case scenario here is when you have a Democratic president and a Republican-controlled House and Senate. Next in line would be a Republican Congress, period, having nothing to do with who the president is, Republican or Democrat. And then number 3 would be a Republican president with Republican-controlled Congress and Senate. The worst ones are a Republican president and a Democratic-controlled House and Senate. The second worst is a Democratic Congress with no regard to who the president is. And then the third best is a Democratic president and a Democratic-controlled Congress and Senate. And so those are the facts. This is not political opinion. Don't shoot the messenger. I'm a hardcore libertarian, and which means that I'm basically like most of you. I'm a social lefty and a fiscal righty, so there is no candidate for me. Anyway, moving on. So let's just kind of summarize here with the big picture. Long-term asset class ranking, we have U.S. stocks. If I haven't beat that horse to death, I'm going to beat it a little bit more. U.S. stocks, again, in this analysis, which is a longer-term analysis, number 1. International stocks are close behind at number 2. Small caps close behind at number 3. For the first time in a while, we're starting to see bonds positive. I'm not saying they're beating stocks. They're not. But at least they're positive now. For a while there, if you look back at previous scouting report videos that I do, market update, halftime updates, the bonds were sitting below money market for quite a while. That was pretty ugly. So we now have bonds above money markets, and then we have commodities that are in the basement here, literally below money market. So if that doesn't, again, reiterate everything else we've been saying today, this is kind of a clean picture. This is another way of looking at it. This is through Dorsey Wright. Dorsey Wright does what's called point and figure charting. It basically takes time out of the picture. So the only thing that matters here is a picture of domestic equities, international stocks, commodities, cash, currencies, and bonds. All went into a round-robin tournament together, and every team played every team until every team had played everybody. And at the end of the day, whoever has the most wins is the number 1 team. Whoever has the second most, and so on and so forth. So this doesn't look at time. It just looks at whether one investment beat the other on a price performance basis only. And as you can see, U.S. stocks, number 1 by pretty big margin. International stocks are number 2. Commodities are number 3. Then cash, currencies, and fixed income in the basement. So what this tells me is I wouldn't want to touch anything that's kind of below this mid mark, but even I'd want to really be focusing on the top 2 asset classes, understanding that you can't just put all your money in stocks if you're a conservative investor. You can't put all your money in stocks if you're a moderate growth investor. If you're a balanced investor, you can't invest all your money in stocks. So with that all being said, you have to have some money in other things. And like I mentioned earlier, in our model portfolios last couple of years, the fixed income portion, which was in the basement and has been in the basement for a while, was invested in stuff that was just really safe, earning a steady rate of return of 5% or more. But now we're starting to see the bond market increase, so therefore it makes sense to start exposing ourselves to bonds. This is my inverse traffic light. Again, we're seeing higher highs, higher lows. We're in the green zone, which for me, the green zone represents the most recent lows here this late summer. And then in July, that little bounce that took place in the middle of that quick correction between July and August, that 3-week correction, we're at all-time highs again, so higher highs. And I could see the market pulling back in this next month to the 5440 level on the S&P. That wouldn't surprise me. Again, the election isn't something that's going to be emotionally easing or emotionally easy on your money. But even if we got into this yellow area, I wouldn't be all that concerned. It's just that once the election's over, we want to see this thing stay above the green area, or if it gets in the yellow area, start to consolidate, chop sideways, and then head higher. And then here we have, this is interesting, this is the investment ICI, so Investment Company Institute from through Bloomberg. I was just noticing that we're sitting on, the country is seeing a record amount of cash on the sidelines. So $6.3 trillion are sitting on the sidelines in cash, and the people that own that cash are going to do something with it. They're either going to buy something, they're going to invest it in something, but I think that what's been happening, for a while now, is we're seeing a lot of cash on the sidelines, and this can base out because people accumulate cash, the population goes up, and so on. But as this cash levels go up and the election ends, I wouldn't be surprised to see some of this cash get deployed into the market, into investments that help the market and things like that. So this is a good sign. This is a good thing. Just some final thoughts on the market. This is my pre-flight checklist. It's just, when I pull this up in the morning, it just gives me a good snapshot of what the market looks like today, what the trends look like short term, intermediate term, long term, the market climate, whether it's safe for new entries into the market, and so on and so forth, depending on sector or major market index. And you can see here short term trends, for the most part, all blue, all good. Intermediate term trends, blue across the board. Long term trends, blue across the board. That's awesome. I mean, it's good. The market is healthy. In really, really short term, when we look at market climate, we're seeing some red on this board. We're seeing some blue, but it's about half and half. So neutral, we'll call it. So we got a neutral market climate with trends that are up. I don't think that's a bad thing. And then safe for new entries, again, about half and half. A bunch of different indicators here. I'm not going to go through them. But things look kind of neutral in terms of safe for new entries, and that's because we are 30 days out from an election, and there's a lot of uncertainty out there. So things are a little choppy, things are volatile, and we're just going to have to see what happens. This is my good friend Andrew Thrasher's volatility trigger from his award-winning paper at the CMT Association years ago. I believe it was 2016. And whenever you see these arrows pointing up down here, it's when his volatility risk trigger is triggered, which indicates a potential for a volatility spike. And right now we're sitting really, really low. So the indicator is pretty low. There's currently not a very high risk of a volatility spike, which is pretty counterintuitive when we just got done talking about how we're almost, a month away from the election. So that's a good thing. And then last but not least here, I always want to remind everybody that, when you're working, when you're in your working years, you've got a job, you're making money, you're saving money. It's okay to have a lot of money in the market and to stay in the market with a good portion of your money, because when the markets go down, you're buying more shares when it's cheaper, and when it comes back up, not if, but when it comes back up, because the market has a positive bias, about 75% of the time it goes up. It's that 25% we want to worry about. But as long as you're still working and you don't need to spend your retirement savings, it's okay to stay in the market and continue buying in your 401k, your Roth IRAs, your brokerage accounts as the market struggles. However, the closer and closer you get to retirement, and when you're retired, it becomes crucially important to avoid, or at least sidestep, catastrophic market crashes, because if you lose 10%, not a big deal, because it only takes mathematically 11% to get back to even. But if you lose 20%, it takes 25% to get back to even, then that can take some time, especially if you're taking money out of the portfolio. It makes it worse, right? Because if you lose 20%, but you took 5% out, now you're down 25. If you're down 30%, it takes 43% to get back to even. Down 40, it takes 67, and so on and so forth. If you're down 50%, it takes 100% return to get back to even. And that's, again, if you didn't take money out of your portfolio. If you take money out of your portfolio to supplement your Social Security, your pension, to help pay for vacations like retirees do, then this is where you have to have more complex ways of managing your money, which in my opinion includes relative strength, momentum, trend following, things of that nature. All right, with that all being said, thank you so much for taking the time. If you'd like a second opinion on your retirement plan, please reach out to us. We have a process that basically goes like this. Every new client that talks to us gets an intro call for about 30 minutes. We get to know you. We explain our process. We answer any questions you have. And if you want to go through the process, we do. If not, we part as friends. If you go through the process, we have a 3-appointment process, which is discovery meeting, about 2.5 hours. Second meeting is called an education meeting. It's about an hour long. And then we have a financial planning meeting, which is about 90 minutes long, after which we decide if we're going to move forward again or part as friends. But at the end of the day, all of this is at no cost to you. It's the reason we give all that away is because roughly 9 out of 10 people who go through that process end up working with us. So if you're in the market to get a second opinion, or if you're just curious, set up an intro call, go to our website at libertaswealth.com, click on that little button that says see if we're a good fit, answer the questions, hit submit. That'll come to us. We'll set up an intro call. We'd love to talk to you. Otherwise, thank you so much for watching this quarter's scouting report. And if you have any questions at all, feel free to get to me personally, and I would be happy to answer any questions you have. But meanwhile, have a wonderful fourth quarter. Enjoy the holiday season, and we'll be back with the market outlook update just after January 1st, 2025.